gold just broke out of its tightest coil in a year. Volatility on the metal compressed to its lowest reading since August of 2025, and the last time gold wound up this tight, it ran 60% over the next 5 months. On Wednesday, the spring finally released. Gold ripped from $4,100 to $4,300 in a single session, a $200 surge, its best one-day move since February. And this is not just a chart event. The biggest buyers in the world spent months building a floor underneath this market. Now the pressure is releasing. Those 2 quiet months were not a dead market, they were accumulation. Here is the setup. Gold fell 30% earlier this year, all the way down to $4,000 an ounce. And then it went nowhere for 2 months. That is what selling exhaustion looks like. Everyone who wanted out got out. Each dip got smaller than the last, and each one was met with aggressive buying from hedge funds, institutions, and central banks. You can measure the coil with Bollinger bands. The wider the bands, the higher the volatility. And days before the breakout, gold's band width printed its lowest reading since August of 2025. Volatility acts like a spring. The tighter it winds, the more violent the release. Volatility never stays compressed, it expands, and it just did. Now the fundamentals. Between April and June, central banks bought 289 tons of gold, the biggest second quarter the World Gold Council has ever recorded. Poland added 82 tons this year, taking its reserves to a record 632, and officials say they are going to 700. Uzbekistan added 41. Central banks have now bought over 1,000 tons a year, 3 years running. Then China changed the rules. On July 24th, Beijing banned paper gold trading for retail customers, and the Shanghai Gold Exchange now settles every trade in physical metal. No more selling 10 claims on the same bar. And to handle the shift, the gold vault at Hong Kong's airport is being expanded from 150 tons of capacity to 1,000. Chinese money is moving the same direction. After 2 straight months of outflows, Chinese gold ETFs flipped to 14 consecutive sessions of inflows, the longest streak since March, with one single day pulling in over $2 billion. With property prices still falling and capital controls trapping savings at home, gold is the release valve. So ask the right question. What happens to the price when paper supply can no longer cap it? Where does it go from here? The call is $10,000 to $12,000 an ounce over the next 2 to 3 years, with gold crossing $6,000 in 2027. Bold? Maybe, but the technicals now match the fundamentals, a shallowing base and a clean breakout on above-average volume. You do not need $500,000 to trade this. One standard gold futures contract controls 100 ounces, about $430,000 of metal. The micro contract controls 10 ounces, about $43,000, and margin runs $5,000 to $10,000. In a retirement account, gold ETFs like GLD or its lower-cost twin GLDM track the metal directly. Entry through the highs at 41.80, stop beneath 40.60, and the line in the sand, 39.75. Moves like this are exactly why a plan matters. At startwithtA.com, you get the signals, the risk rules, and the education to trade breakouts like this with defined risk. Start your journey at startwithtA.com. The link is below. That is the briefing from the Traders Agency team. Subscribe for daily market analysis. This is education, not financial advice. Trade smart.